My name is Andrew Dix, and I am the publisher of Crowdfund Insider. We cover fintech news, including online capital formation. And today, we're going to talk about debt securities and crowdfunding. And we have two experts with us here today, which I'm very pleased about. We have Eitan Butler from Dalmore Group. He's been with us here several times. And we have Matt Willer with Phoenix Capital Group, an issuer. And so to kick things off, I'm going to ask each of you to kind of share who you are. And we're going to start with Matt, please.
Great. Well, Andrew, thank you for the introduction. And it's always a pleasure to be here with Eitan, who I work with in various capacities, which we'll discuss later. But by way of background, I went to the University of Southern California, attended their Marshall School of Business. That was back in the 1990s. Graduated with a degree in finance, and then began my career as an investment banker with a firm by the name of Smith Barney, which was subsequently acquired by Morgan Stanley. So I've been kind of on both sides of the aisle, for lack of a better term. I've been on the banking side, where we're constructing deals and bringing them to market, which is ultimately resulting in the issuance of securities. And then separate and apart from that, I've been on the issuer side, where I am right now as a principal with an organization that is issuing securities, in this case, debt securities. And so that does give me some interesting perspective because I've been in both worlds. So we are an issuer, as Andrew mentioned, of debt securities. This comes by way of 26 years of background on both sides of the aisle. But I enjoy everything that we do, and I look forward to sharing more with you as we get to that point in the presentation.
Thank you, Matt. Eitan.
Andrew, brother, great to see you. And Matt, lovely to share the stage with you. I know this isn't your first webinar. And so Eitan Butler here. I'm the chairman at Dalmore Group. Dalmore is a tech-driven broker-dealer that assists companies that are looking to raise capital primarily online at scale through a number of different securities exemptions that allow for companies to broadly market and promote their securities offerings in a compliant way. And through some of these exemptions, accept investments from anyone over the age of 18, pretty much in the world. And we were founded in 2005. We've worked with over 1,000 companies, including over 320 Regulation A clients. I've done over 1 million Regulation A investments. And so grateful and pleased to be back here today talking about the debt side of the market, in that so frequently we see online capital raising activity associated with startups raising equity capital. Not many people think about the fact that these tools could be used to build communities and it could issue securities that offer potential yield for investors as well.
Awesome. So thank you both for being here. So I want to start to talk about the debt securities markets in contrast to equity securities markets. When I went to business school, one of the things that I learned is that equity markets are far smaller than debt markets. And so I pulled up some data today to look at the numbers for, I believe it was for 2022, that global issuance for equity was about $400 million in 2022. It was a soft year because the economy was bad, but you know that kind of gives you a ballpark of what's going on around the world. You contrast that to long-term fixed income issuance, that stood about $22.5 trillion in 2022. So it's magnitudes of difference where debt markets are far larger than equity markets. And I think when I think about crowdfunding, initially in the early days, everybody said equity crowdfunding, because people conceptualized early stage funding of startups, and people really focused on ownership in these firms. But what people didn't realize is that raising money online is not just constricted to equity securities. It includes debt securities and other securities for that matter. And so today, the full spectrum of securities exemptions are being utilized to raise debt capital, whether it's a loan, it's a bond, or something else. This is something that I think is going to continue to grow and has really generated a lot of traction in the past 12 months. So I want to start to ask you, Eitan. So you've emerged as one of the most active platforms in the Reg A plus market, where you can raise up to $75 million. I want to hear from you what you're seeing in the debt markets today, because I know you're doing all types of different securities. What is Dalmore Group seeing today with debt offerings?
So, it depends on the exemption, right? So if you're looking to launch a Reg CF, a crowdfunding offering, you're limited to raising up to $5 million per year. And those are typically raises that are done for startups looking for equity capital, for growth capital. There are some exceptions, and there are platforms that focus on kind of bank replacement, or kind of like community pizza shop, or service, kind of like, small shop, small town, kind of like, local loans that are made $50,000 at a time, $100,000 at a time. That's not the area of the business or the scope that Dalmore is really focused on. Historically, you see yield-based offerings conducted through Regulation D, right? Regulation D allows a company to raise an unlimited amount of money or issue an unlimited amount of debt, but only to accredited investors, right? And they have to prove that they're accredited, which adds some friction to the equation. And they represent, I don't know, roughly 10% or so of the U.S. population. What Dalmore is seeing, which is really interesting, is a rise in yield-based offerings, Reg A yield-based offerings. These are typically perpetual offerings. These are issuers that are creating REITs or bonds, issuing bonds that offer a potential yield to investors rather than equity participation. And one of the benefits of Regulation A, again, you could raise capital from anyone over 18. So if you're marketing and promoting this and you're advertising your offering, might as well position yourself to be able to service 100% of the population over 18 rather than just 10 or so percent of it. So what we're seeing are issuers that are utilizing Reg A for this purpose to expand their community and offer debt-related products to them. We're seeing the most growth in yield-based offerings because of the nature of the issuers, I believe. If you're looking to raise X amount of capital as a startup for equity, generally that's a one and done type of an approach. Whereas if you're a perpetual issuer and you have a scalable strategy, then you're looking to build community and offer your investors an opportunity to get access to that potential yield. And oftentimes what happens is, if you do right by them and you deliver on time as promised, then trust can develop, and then they end up reinvesting and telling their families about it, and you develop a reputation as a result of that. Those are great clients for us because they're perpetual issuers rather than just a one and done capital raise. And I think that the ease that these exemptions and the technology that's involved makes it that much easier to utilize all different types of means, whether that's webinars or whether that's advertising and promotion through Facebook and social media. You could take your message, you could take private capital markets yield-based opportunities, which dwarf the public markets, and you could finally put organization around them, make them secure through these exemptions, and then offer them to investors. So really bullish about that segment of the business, and we're seeing a lot of growth there.
Awesome. So you raised a couple of points there that I want to back up and look at again. The first one you mentioned is bank replacements, and this is something that has caught my attention recently, and it was kind of driven by, there was one platform that's in the CF space that has seen a dramatic increase in growth in, I think, the past year. And actually, we ran an article just recently where we got some data that indicated that this specific platform had seen over 100% growth in offerings year over year for the month of October. And this is a bank replacement. It's where you can effectively get a peer-to-peer loan by going to a platform, and the small business can issue debt, a loan, whatever you want to call it, and the investor can get yield. Can both of you talk about, why this has occurred in the current environment? We just wrote something today about big banks have backed off on approving loans for small businesses. Maybe Matt, you want to share your point of view there? I know you're,
Well, I mean, and to build upon what Eitan just alluded to, we're that serial issuer. Okay, so we're actively one of his clients. That is exactly what he just demonstrated on more of a macro perspective. So I think one of the reasons that debt securities has become a little bit more pervasive in the exempt securities market is also some of the market conditions, right? We came out of a zero interest rate environment. So it's very challenging for people to find yield. All right. So there's an appetite there and sometimes unsatiated appetite. Secondly, debt sits before equity. So if you're looking for those less risky type of investor or investments, debt is going to sit in front of the capital stack. And of course, it's different by every issuer. But the ease of these exemptions is the main thing, because as Eitan mentioned, Regulation D has been around for a long time, except it was almost exclusively real estate deals and you'd find yield there, but it was never anything more. And it was only open to that upper 10% of our society. So you have market that has unmet demand. All right. There's an appetite for yield in a zero yield environment, in an inflationary environment, and with a security profile that's quite a bit different than equities. So that's kind of the market scope. These exemptions allow rubber to meet road for issuers that recognize the opportunity, et cetera. Now, as it pertains to replacing banks, well, there's a lot of reports out there as recently as this week that private credit in general is going to be double what it is today by the year 2030. And so that's not just the issuance of securities, that's your Alliance Bernsteins and others replacing bank loans. Why is that happening? Because banks have tightened their belts like no one's business. And unless you check their catalog of boxes, time in business, XYZ ratios, a lot of people are moving to asset base. Basically, the banks have narrowed their scope to only bank those that don't need to borrow money. And so now appetite for it, and with that comes a higher yield component, right? So there's a lot of moving parts here, but in aggregate, the market is large and the technology is enabling it to reach people that have this type of appetite more efficiently than ever. So I'll pass it to Eitan with that kind of backdrop.
Yeah, no, thanks. There is a CF platform. I think they're called Honeycomb, right? That's focused on making smaller loans. I think it's wonderful what they do, and I think it's really in line with some of the intention of the early days of the Jobs Act, which is to democratize, to give the little guy who has a restaurant and needs $50,000 to put a pizza oven in, to go to their community and their fans saying, hey, this is what we're doing. You appreciate us. You could be a part of this, and we need a loan, and we're going to offer you X amount. And it's not so easy to borrow for them to borrow from banks. So I think that makes sense to that degree. It's not necessarily the side of the business per se that Dalmore is focused on. We're focused more on issuers that are typically looking to max out some of these exemptions or utilize them on a repeat basis, perhaps representing giving their investors access to a portfolio of these loan opportunities rather than an individual borrower engaging us seeking a smaller amount for themselves. So we're more focused on supporting the platforms from a broker-dealer regulatory compliance and technology perspective than the smaller type issuers. I will say though that the one challenge here is that we're seeing here is that 5% interest rates, right? So you got to have something that people feel really confident about, that represents a chance to make more than 5%, right? That's the competition which has presented itself in the last several months, which is why not keep your money in the bank? Whereas in the past I was looking at like a 6% REIT that was interesting, or a 5% bond. That's not as compelling as it used to be, right? So issuers need to do both. They need to bring a track record. They need to bring a potential to make a significantly higher yield that one has available in the bank, and build accordingly. And I think that's a challenge. It's also the opportunity there.
So okay, I mean, both of you have touched on some important topics here. Matt, you mentioned kind of the risk profile, where you have reduced risk in regards to debt securities, and that's appealing for investors right now. What about interest rate risk? I mean, and duration for a loan. Eitan, are you seeing mostly short-term issuers, like 6 to 12 months? Are you seeing longer-term issuers in the debt side? What are you seeing today?
I think it's important to realize that these exemptions really represent tools that allow for an issuer to take whatever share class structure and valuation structure that's reasonable to the market, right? So there's opportunities for issuers to bring investors in to replace any portion of the traditional capital stack. That could be equity, it could be preferred, it could be subordinated, generally the less complicated it is, the easier it is for the average investor to understand. Right, so you don't typically see these really complex structures when you're looking for $5,000 investments from on an iPhone, right? So you want to keep it somewhat simple. You want to keep it aligned, but I think that we have examples of so many different issuers utilize debt and yield based issuers that are coming up with really innovative structures. While at the same time, we're seeing a lot of flow through revenue from rental, single family home rentals, right? So you'll have an issuer that'll acquire homes and then offer a flow through of that rental revenue to their investor base. We're seeing a lot of that activity as well.
Okay, so well, let's talk about that. What type of securities are you seeing? Are you seeing convertibles? Obviously, you're seeing a lot of reset real estate backed issuance. Yeah. What else are you seeing out there in kind of the panoply of different types of debt securities? I know you're big on serial issuers, where they'll go out and they'll raise 50 million this year, 50 million the next year, and they'll just keep doing it again and again and again. What is kind of the range that you're seeing? What's some of the creative stuff you're seeing today?
We're seeing income producing mineral assets, of course. We're seeing athlete contracts, right? Where the athlete is the asset. Yeah. We're seeing music royalties. We're seeing revenue shares for single family homes. Yeah, all kinds of. Yeah.
So that's cool. Can you share a little bit of detail on the royalty thing? How does that work?
Music royalties. Offering exposure to traditional music royalties generated from entertainers and artists, and revenue streams from influencers and revenue streams from athletes. The structures vary to a degree, but ultimately you're fractionalizing receivables or future receivables, and you're offering investors an opportunity to participate in them and buy shares in a number of different structures that give them exposure.
So for example, I could invest in a Taylor Swift song, just as an example, and I get a small fraction of that revenue.
You could buy. There's issuers where you could buy shares of a song. There's issuers where you could buy shares of a portfolio of music royalties. There's issuers that allow for all different types of structures, right? Athletes, future revenues for athletes. I mean, that's really cool. That's similar to the fantasy sports, right? It's in a way, right? It's a similar model. But that's really what we're seeing. Everything is being fractionalized, across multiple industries. Art is another big space that we're seeing a lot of issuers. Cars, right? Collectibles in that way. But yeah. It's but most of them are. I would say the majority of our issuers that are setting up fractional platforms and offering yield-based issuances are in the real estate space.
Okay, all right. And you mentioned revenue share. Is this in perpetuity, or is there a hurdle rate where once you hit a certain amount, then it stops or diminishes? I'm sure it's all sorts of different
there's all sorts of them where you as far as the scale of payback to investors and for how long and at what percentage, but the majority of them try to keep it very simple. You have perpetual interest in a performing asset or exposure to an asset for the duration, right? That's really that represents the majority of the real estate issuers that we're working with that are fractionalizing shares for investors.
So, are you seeing a lot of activity in the real estate markets today when the interest rates are so high, or is that something that's diminishing?
We're seeing it's growing year after year significantly.
Okay.
Perhaps it would be growing even faster, but I think we're at the age of the internet right now, and that you can't have a conversation without getting back to the reality where today people are transacting and expect to be able to easily transact from their iPhones and iPads, the same way that they do from Amazon Prime and Instacart. So you make something really easy for someone and give them really good technology that allows them to link their bank account, and you report to them and you do right by them and you're transparent and you answer questions and you deliver, then they tend to be loyal over time. And so again, like getting back to what I was saying, what's interesting is really the rise in interest rates that are available through banks now. So issuers that like REITs are competing with banks that are also on Facebook offering 5%. So you got to have something that's a bit more compelling if you want people to go and give it a shot and sign up for your platform. So so that I think is relatively new, and so we'll see how long that lasts. But it's definitely worth noting.
Okay, so let's talk about the different exemptions quickly. I want to go back to those because in the U.S., the vast majority of online capital formation happens under Reg CF, raise up to 5 million, Reg A plus up to 75 million, Reg D unlimited but must be accredited.
Yes.
Is Dalmore seeing any activity in Reg CF for debt securities or minimal, or is it mostly equity raises and for that exemption?
It's mostly equity raises for that exemption, with the exception that because you could launch a Reg CF offering generally for a lot less of an investment, because you don't need really significant legal bills like you do for SEC qualification, because Reg C is a notice filing, and because you could typically get a Reg CF up and running in a matter of weeks rather than a matter of months and beyond that typically it takes for a Reg A, that issuers that are coming to market with a yield-based offering strategy and looking to build a community may start with a CF. First, prove that you can raise up to 5 million before you go nuts and start hiring an attorney for a Reg A, right? So so we are seeing Reg CF used for that purpose, but generally the intention is for only until you prove that you could. Once you raise a few $1 million, then you file for the Reg A, which allows you to raise up to 75 a year from anyone over 18. So people are starting with a CF and a D. They're directing maybe accredited investors to the D, the non-accredited investors to the CF, raise up to $5 million. Once you got some stability and predictability, you could then kind of go take it from there.
Yeah, you mentioned something that I want to clarify because I understand this stuff, but most people shouldn't know this stuff. that Reg CF is a notice filing, whereas Reg A plus is a qualified offering. Do you want to explain the difference between the two very quickly?
Yeah. So Reg CF is short for regulation crowdfunding, where you could an issuer could raise up to $5 million a year from anyone over the age of 18. And in order to launch a Reg CF offering, you need to go through due diligence. You need to have a broker dealer or a funding portal ultimately, and then your securities counsel does a notice filing. It's called a Form C. Does a notice filing with the SEC. In other words, I'm setting up shop. I'm going live in a few days, right? It's a notice filing. Whereas a Regulation A is a much different process. Regulation A, you have to file an offering circular with the SEC. They have about a month or so to get back to you with comments and questions. You got to respond to them, and ultimately they need to issue a qualification letter, right? They have to qualify the offering, not approve it, qualify it, and only then can you go live once it's qualified. And that process is more expensive and takes a lot longer, right? It could often be up to $100,000 in some cost to get a Reg A up. Or more, and then it could take 4, 5, 6 plus months and to go up. Whereas a Reg CF, much cheaper to get up and running, much quicker. You're talking about weeks, 5, 6, 7 weeks typically that it takes. So might as well start there, because both of them give you the opportunity with our technology to have a landing page and to invite investors to come check out what you're offering and an invitation for anyone over 18 to participate. So it's we're seeing more Reg CF used as a stepping stone than a ultimate destination.
Okay, so it sounds to me that if you're just getting starting, that doing a Reg CF combined with the Reg D offering could be a viable path if you want to raise, $10 million faster, get the offering live quicker, because Reg D is a notice filing too, right? You don't have a qualified offering, and then return to a Reg A plus, where you raise up to 75 million from anybody.
With the exception that the one thing that's really unique about Reg A, but not necessarily relevant for everyone, is that the securities of a Reg A are freely tradable, right? So whereas Reg D and CF, there's a 1-year hold before investors could theoretically trade their shares if they could find someone to trade them with. So when if the strategy is to fractionalize single family homes into dollar shares, and you want to create an exchange by having a bid and ask right next to the IPO of these assets, then you may consider Reg A for that offering, because secondary trading is embedded into your strategy by creating an exchange. So in those types of cases, those types of issuers, they may forego the CF and D and move right to an A.
Yeah, and I'd like to mention too that you can trade debt securities just like you can trade equity securities. Again, because of the nomenclature, people tend to think about trading shares, when really you can trade anything, and that is a unique feature to Reg A Plus is any offering can be tradable if the issuer decides. There's one other aspect that I'd like to touch on very quickly. I think for companies looking to raise capital, doing a debt security is non-dilutive capital. So you're raising money while you're not diluting the ownership of your firm. This can be interesting to some issuers, right? And Todd, Matt, I don't know if you've ever had that conversation, but I think that's something that companies talk about, especially if you have an existing cash flow where you have an ongoing business that's a little bit more established.
Yeah, it's talked about it. It's the entire reason why we're doing it. We don't want to part with the equity in our organization. Now, again, Eitan knows better than most. There's a vast landscape. He's worked with 1,000 issuers over time. We happen to be more mature than some other organizations as it pertains to an exempt securities issuer, right? We have a real balance sheet. We have cash flows. We have real asset portfolio. So for us, this instrument is a little bit easier to issue than a startup, right? Because what's backing the securities, whether it be a bond, a note, a mortgage, et cetera. What type of operating history does the company have, et cetera. So it would be a little bit more challenging, perhaps, to have a nascent stage organization come out of the box with debt. It's not to say it can't happen, but usually that's something for an organization that already has a little bit more of an established track record, and it can augment equity as well, right? It doesn't have to be one or the other. There are many companies that will IPO in a traditional fashion outside of the exempt securities market, and they still have a bank revolving line of credit, right? They play together in the capital stack. So this, I think one of the most salient things that Eitan said, these are just tools. They're instruments. And then it allows issuers like us to mold them into the structure that we're trying to achieve. But it's the vehicle that we're talking about. And then the technology brings that vehicle to the masses. So I don't think we have to box everyone into one cookie cutter thing. These are the elements that create the offering.
Okay, so I think that's kind of a good entree into what Phoenix is doing, because you and we had a conversation a couple of weeks ago, and I had reviewed your offering circular a little bit, but you provided more insight. Could you share that with our audience? Exactly what Phoenix Group is doing in your securities offering, and also you correct me if I'm wrong, but you did one not too long ago. This is your second one, but the first one sold out rapidly. I mean, you had a lot of interest, so maybe you could touch on that too. But can you describe the structure of this oil and gas investment? What people are backing when they invest in Phoenix? Sure.
So our company is an oil and gas company. We buy real property with our own money and that of investors. The subset of the sector that we're interested in acquiring assets are all assets that are cash flow assets, right? They're not speculative. These are assets that either have cash flow or there's a very quick path to it. And we finance that through the issuance of corporate bonds. So we're the issuer. The security is a corporate bond. Now, they happen to be unsecured, but that doesn't mean they're inherently risky. It's because we wanted a universal class of securities that was effectively backed by all of the assets of the organization. Okay, so we have been issuing corporate bonds for several years. That is supplementing our own capital because we have cash flow that we reinvest from our asset pool. And it's been a very well-received vehicle within the marketplace. We have over 4,000 individual investors from 5,000 all the way to 5 million and everywhere in between, because we are a running concurrent Reg A's and D's. So we direct our accredited investor, which is call it 10 to 13% of the country, to our D, and the everyday American can invest in the A. Now, the reason that we run those in parallel is largely for capacity, but also the Reg D investors get the benefit of the disclosure of Reg A. So it's a requisite of the SEC that you have audited financial statements. So if we were D only, we would have a smaller pool of people to work with. And unless we were proactive with our transparency, which we are, then they would have a harder time finding information. So we found this to be a good strategy given the scale of our company. To your point, this has been a well-received offering. Now, we can't take any credit for headwinds. When we launched the first offering, your 5% CD was 1%. Okay, so there was a huge appetite for anything relevant, especially in the inflationary environment that we live in. So we got a lot of traction very early on for a lot of reasons, and that has continued. So I think what you're referencing is we fully subscribed our Reg A, which is 75 million, because that's the tier of issuer that we are. And then you can do what's called a PQA. It's a filing that anything that is securities that have been issued 12 months or further from now, I'll say, so 13 months or older type of thing, you can get those numbers back into your 75 million. So what you're referencing is we added back 22.5 million of the overall initial 75. So we got 22.5 back that we could issue. We relaunched it September of this year. So like a month and a half, not long ago. And we filled it in 10 days. So 22.5 million shows you what Eitan referenced early on. We built an ecosystem. We do what we say what we do. We're transparent. People get good service. And at the end of the day, the expectations are met. And that lends itself to repeat investment and telling a friend, family member, or neighbor. So we're really feeling like we're only in the second or third inning of this corporate finance initiative, but we're probably a little bit more mature, whether it be time in business or size of the company, than the average exempt security issuer. But it shows you what's possible because we started in that same bucket as well. The first time I met Eitan, 0 investors, not one. And we launched Reg A with them, and then we came back to them when we were really at scale. And it's been a beautiful partnership. But we are a case study, if you want, from never once issued a security as an organization. I came in, I built the division. We've now raised almost $500 million, and that's over the last 2.5 years. So with the right offering and the right personnel, the right platform and platform partner, et cetera, like there's a lot of possibilities here of all different sizes for all different issuers. You just need the tools and the vision.
And, when we had this conversation, you said something that really rang true for me. And it was interesting because, you have raised almost $500 million. For me, that's a fair amount of money. But in the world of oil and gas, you guys are still pretty small. And you said something about, well, we just can't walk out to a bank and get a loan because we're not big enough. You're mid-market or mid-small. I don't understand your industry like you do, obviously. And so leveraging Reg A, Reg D was the path to fund your operations for hundreds of millions of dollars now, because you can't just go to the banks or go to the public markets like big oil can. Mm-hmm. And this it really enabled your entire company. Is that correct?
Absolutely. Now, there's some other moving parts given the industry that we're in. So you have political and ESG influences that have kind of made their way into the boardroom. So we recognize that, though, and we're somewhat agnostic to it. We say we have a business plan. The business plan requires capital. What's the most cost-effective, efficient way to access capital in the debt arena? Well, 10 years ago, it would have been going to a regional commercial bank, right? Now that capital's largely dried up. So if you're a mom and pop, someone that's going to personally guarantee a 10 or $20 million line of credit, that money's still there. You're Exxon, well, you can go anywhere you want. Now you're shopping for the cheapest money. The lower middle market and the middle market of oil and gas is largely underserved by conventional capital, certainly conventional debt capital. And so we just said, listen, if we're going to execute on the timeline that we have committed to internally, there's a finite amount of capital that's going to be required to meet or exceed these goals. And this is the way to do it. And so we came in and we did it. And we didn't know how it was going to work out. So I don't want to take like a hindsight view victory lap here. We're still at it, right? We're still growing. We feel like all we've developed so far, yes, $500 million, but for us, it's proof of concept. That it works. There's an appetite for it. People are investing and investing again. Now we know we can duplicate at scale. So in the overall the debt markets that you were talking about in the very early part of this, trillions and trillions and trillions. So $500 million might sound like a large number at my dinner table, but it's not a big number at all in the scope of what the overall corporate debt markets are in this country. So yeah, there's some industry specific stuff that made this even more logical for us. But yeah, it's a whole different banking landscape in oil and gas than it was, say, 10 years ago.
Yeah, so I mean, online capital formation has really enabled Phoenix as an early stage venture because you're pretty young, you're years old, right? Correct me if I'm wrong, and this has enabled a concept in a group of entrepreneurs who have some expertise in a specific market to raise the growth capital they need. And I think that's really cool. Now, the specific security that you're offering today, which anybody can invest in, it is what? You're investing 1,000, I don't know, 5,000, what's your minimum?
Yeah, so they're both corporate bonds, but they're under two different offering parameters. So the Regulation A+, that's open to anyone age 18 or older, doesn't matter their income or net worth, that's a $5,000 minimum. All corporate bonds in the United States from any issuer are $1,000 each, so there's no different here. 5,000 just represents 5 bonds. You can do anything you want thereafter in $1,000 increments. Separate and apart from that is a Regulation D offering where we've got to validate accreditation. And there are generally comparable terms available to both sides, but the $100,000 minimum pertains to the Reg D. So we run those concurrently, and we have a lot of participation in both. But they're corporate bonds backed by the good faith and financial resources of the organization. We also, to Eitan's point, we tried to keep it simple, a complex structure. If you could imagine who's on the other end of the phone, typically with me, it's folks that are retired or approaching retirement, and they say, "Listen, I've been through enough of the roller coaster of the markets here in the last 3 years, but I can't make enough at a bank or a treasury with inflation where it is to make me comfortable. So I'm looking for a little bit more." Well, that investor also needs something that is simple, they can understand, it's transparent. And that's really what we built. We don't have 20 different classes of securities. You're not subordinated or junior to this and senior to that. We have a bank and we have our bondholders, and that's it. And then equity, that's myself and my partners. So we try to keep it that simple because we don't know when we're dealing with thousands and thousands of people, which guy's the CFO and which guy's the carpenter. And we want both of them to have the information and comfort that they would from their background. So corporate bond, simple structure, and that's proved to have appetite.
You also have a redemption policy.
We do, because so we talked a little bit about these secondary trading opportunities, right? You can list securities, at least in the Reg A, on a secondary exchange. Well, we chose not to do that for 2 reasons. And in certain conditions, I would absolutely do it. But in our circumstance, the reason we chose not to engage in secondary trading is twofold. One, we want all the capital coming into the primary issuance. Okay, I don't want new capital trading with old capital, and then we're not. This is a primary issuance. We're raising capital. So any capital that's interested in the bonds, we want the capital coming into the company. That's point 1. Point 2 is more a reflection of our audience that I just shared with you. We're dealing with people that are retired or approaching retirement, largely coming to us because they don't want market correlated exposure. Once you put it on an exchange, now there's market forces influencing the price of the security. So we are the redemption policy. We are the market for our securities. If someone wants to cash out at maturity or in advance of maturity, there's a path for them to do so. And we've been through millions of dollars of both. So we do have a redemption policy, but our investors, we are the market for the securities.
What's the term right now for your
we have terms from 1 year all the way to 11 and everywhere in between. So it's really, up to the investor in terms of their duration. Since we work with a lot of qualified funds, about a third of our capital have come from, say, IRAs or other comparable vehicles. A lot of those folks will gravitate towards the longer term, highest rate compounding type of options because that's funds that they don't live off of. In many cases, they can't access it for years and they want to set it and forget it. Whereas you have some of our larger cash investors that say, hey, listen, just like I'm comfortable with a 1 year CD, I'm interested in a 1 year bond. So I have flexibility. But when you're dealing with thousands of people, you have thousands of different perspectives that influence. So we just gave people choices.
Okay. So you're taking the money and you're investing in oil wells and you're operating them,
I'll make it real clear. So by the time the money comes to us, it's already spoken for, okay? Because we're buying real property that has wells either existing on the property and existing cash flow, or the wells are being drilled and completed as we speak. So everything is either cash flow or a very quick path to it. The underlying asset is deeded real property. That's what we're buying, but we're buying the property for the cash flow. So when we're taking in capital from an investor, it put in a pool with our money and every other investor's capital that's come in. And then we're slicing and dicing it on our closing list, which we get every Monday from our partner meeting. And right now, we have like 112 assets that we have under contract that will be closing between now and December 31st, from 50,000 to 20 million and everywhere in between. So we're using the capital to deploy to those types of assets. And when it comes to us, we've already committed it.
And at what point, I know that the price per barrel it's a common metric for the oil and gas industry. At what point do you guys make money in price per barrel?
If we were unhedged, we'll call that naked long, right? If we didn't have any instrument to protect our downside to oil, our break-even range goes from $26 to $40 a barrel, depending on the month, because our expenses are not static. So it's a low break-even point. Frankly, it's materially lower than the larger operators like Exxon and so forth, which puts us in a pretty favorable position because companies with a higher overhead are not drilling new wells if they're running at a break-even or less. And so that kind of puts an artificial floor on the market. Now, we're not gamblers or risk takers. And then the second you bring in debt capital from retirees, you have an obligation to protect that capital. So we hedge our portfolio at 55 a barrel. And the rationale for that is basic math. At 55, we record a material profit as a company, and that's the only way we make money because we don't charge fees on the investment. More importantly, to our 4,000 investors, at $55 a barrel, if we get caught in another COVID-19, which we did, we can pay our bondholder interest and redemption obligations, even if the market is unhinged in the background. So I don't want to get too far into the weeds because I know the purpose isn't a storyboard on Phoenix Capital Group, but it is a unique business with unique risk profiles, and we feel like we address those responsibly. Myself and my partners, didn't just come out of the oil patch. We come from sophisticated finance and engineering backgrounds, so we know how to navigate this in the best way we can.
No, I think it's very interesting, and I think with the price per barrel is around $90 today. And I personally don't anticipate it going down much in the near term. And then on top of that, you have the political risk where currently there's an administration that for whatever reason, they don't like oil and they've made some decisions to make that clear. So I find it, a really interesting market in general. And it's one that's vital to the operation of this country. And actually vital to the operation of the world.
It's a delicate topic, right? Because I don't know why it's so delicate, but 30, 40 years ago, it wouldn't have been this visceral. Now, 100% of the country needs us and half the country hates us, right? I'm not anti-climate change. I'm not anti-electric. Far from it. I have children, right? I want everyone to be able to enjoy the outdoors and et cetera. But unfortunately, the divisiveness is coming from the news stories indicating that we're going to be able to change all this in 2 to 3 years. So you have to temper that with commercial reality and say, listen, you can hate oil all you want, but it's going to be relevant throughout your lifetime and mine. And the sooner we come up with a more cohesive plan of how we're getting from where we are today to where we want to be down the road, then it might be a little bit less divisive. But in the meantime, the policies are largely punitive to production. In about your first year of finance, you're going to understand supply demand economics. So if you have demand that is rising and it's going to rise with or without policy, and you have supply that's tightening because of policy, hence $90 barrels. So, I mean, we listen to it and get a chuckle, but it's not impacting us because that's federal land and federal leases, and we only deal with private property in oil-friendly states. So we just get the benefit of a lifted price.
Okay. So Eitan, I want to ask you a quick question here. So we have a novel issuer that's in a niche industry that is getting a lot of traction. You guys are the broker-dealer of record. You and your tool set help the issuance and the management of this securities offering. What all does Dalmore provide for this debt security offering? Is it just your name on the paper? You read everything and say, we're good to go. I mean, how far along do you guys go with managing the offering, managing the investors? What all does that entail from Dalmore's side?
It's pretty comprehensive, and to explain it best, it's broken up amongst really two relationships, sometimes one of two. There's Dalmore Group, which is a FINRA broker-dealer that an issuer would engage us to act as the broker-dealer of record on the offering. And that would include things that are mostly compliance and administrative in function, things like due diligence, bad actor checks, reviewing the advertising materials, reviewing and approving each investor from a KYC, anti-money laundering, OFAC suitability perspective. If it was accredited, making sure that they're properly accredited, really checks and balances in that regard. And then there's our affiliate Dalmore Technology, which provides a suite of capital raising technology tools for issuers that range from an invest button that an issuer could place on their website, that to accept investments from, depending on the exemption that they're in, all the way to a white label app called Dalmore Fraction, which is built for issuers who are perpetually in the business or fractionalizing asset after asset, as like the collectible side of the business that we're on as well. So it is pretty comprehensive. It's not just putting our name on something. It's a very serious role, and we also try to be helpful in talking about, we're observing what's working and what isn't amongst all of our hundreds of clients, right? Webinars are a component, or digital marketing is a component, and PR is a component. Who do you work with? What's working and why? What's the importance of reducing friction so that investors have a cleaner, easier way to get through the investment process? The last thing people want when you're asking them to give you their social security number and make an investment with their hard-earned money are unnecessary steps of friction. It's really aggravating. So the key is to keep the process compliant, but also to remove as much friction as possible. And that requires constant innovation and monitoring. So I think what we represent really is a path for an issuer of any type of securities, ideally to look at us as a one-stop shop, right? Because we could help them with the technology, we could help them with the regulatory, we could help them with the consultative approach towards how to utilize these different exemptions based on where they are, what industry they're in, what their objectives are. We could point to many of our issuers that have, as different examples of ongoing and successful active issuers and what they're doing that is helping them win and succeed in that way. And also what some of the struggles that issuers have. We do happen to have a lot of highlight clients, and I'm sure you'll see a lot of that, in press releases and things like that. But we also like to talk about what's not working. It's not as easy as setting up shop and having a landing page with an invest button on it. Matt can tell you that it's constant work across so many different channels. You really need a well lubricated machine if you want to build trust, right? So you need to have a really strong operating business that could produce quality investment opportunities at scale, number one. Two is you need incredible frictionless technology. Three, you need super effective marketing and promotion, right? You figure all those out, Then your job is to actually deliver on your word and pay investors their distributions on time, build up a reputation. You do those things though, and I could point to a lot of examples of issuer clients of ours that I think have a lot of equity value in their loyal customer base. And you're able to bring them different types of investment opportunities, right? Not just different bond yielding, bonds with different yield terms, but you could also bring them other types of products, equity or debt, once you have a captive audience that has trust. That's how I would describe it.
Okay, it takes effort. There's no such thing as like.
It's no such thing. It is like Elon Musk described. It's the life of an entrepreneur. It's like walking up a mountain barefoot, chewing glass. It is like you have to be in the business. It's the journey. It's not it's like you have to be willing to move and bend, and things come up, technology issues, marketing issues, compliance related things, regulatory related things. It's very under scrutiny, and all these different pieces have to function really in a smooth way, so that ultimately the investor's experience could be fluid and comfortable from that perspective, and that takes a lot of work and a lot of expertise. And I admire companies that have built active ongoing repeat investors over time. Important to note, we are a broker dealer, and this is not a endorsement of any company or a recommendation to purchase any securities. I want to be very clear about that in case investors are watching. But nonetheless, what some of these platforms have done in building up thousands and thousands of loyal active investors is really the direction I think the private capital markets are moving in, and Phoenix and others are examples. Yeah.
Okay, so I want to move over to questions now, because I guess we have a number of questions in the chat here to start sharing these questions with you all. I will echo the fact that it's very important that you work with a broker dealer, a tech platform, a legal advisor, an accountant to get all your ducks in a row. You have to work with people that know what they're doing, that have experience in this industry, because it's a heavy lift. But if you do it right, it can work for you. So my 2 cents. So I'm going to go down some of these questions. This is for both of you. What due diligence process should I undertake when evaluating a company's debt offering through crowdfunding? What information should I seek to ensure that I'm making an informed investment decision? I'm going to start with you, Matt. I'll give you that one.
Well, I mean, there's, this is not unique to crowdfunding, right? If I'm looking at a debt offering, one thing I would probably out of the gates, what is the structure? Where does it sit in the capital stack? Am I first in line, second in line, last in line? That's all about the instrument, right? So getting to understand the security and where you sit. Second, I would look at ratios, assets to liability, interest coverage ratios, right? What's the ability to service the obligation? What's the ability to repay? And ultimately, what would happen in the event of a default, right? What is the doomsday scenario look like, et cetera? Now that, again, it's not unique to Reg D or Reg CF or Reg A. It's what are the conditions under which I feel comfortable lending this company money? Because that's a bond, a note, or a mortgage. And so how would you answer that question if you were lending money to a friend outside of the friendship factor, right? Does he have resources? Where's the cash flow coming from? Does he have more assets than liabilities? Those are kind of the first paths. And then I would also, especially with Reg A, I would encourage you to look at the audited financial statements, not just stuff that's management prepared, so that you have your own checks and balances. That's probably enough on that topic, and that's just my 2 cents.
Eitan, do you want to add anything to that?
I would just say look at everything. I mean, strip away the nature of how people learn about these investments typically revolve around marketing and promotion, and as an investor, you kind of want to put that aside and focus on the fundamentals and look at all of the disclosures, look at the background of the people involved, look at their track record, and diversify, speak to them. Again, like I would encourage as much diligence as possible for investors, and to understand that that there's risk of losing your entire principal in any investment that you make. And so you have to really look at this carefully.
Yeah, and I'd add that I think Phoenix, you guys do a lot of webinars to engage with investors, so you let them ask the questions, the tough questions, And I think that helps. You need that transparency. Under Reg A, you have the offering circular. That includes loads of information. For any investor, read that stuff. I mean, it's vital that you read that stuff.
And we darn well paid for it. As Eitan knows, the winners in this are the Securities Council, so please do read it.
Yeah, that's the truth. What are the potential risks and rewards of investing in a debt offering through crowdfunding compared to traditional fixed income investments? And I guess that means, public markets. Do you guys want to provide any perspective of that? I would see it as the same.
Well, I just say that the more traditional issuances oftentimes might have a layer of diligence that's conducted on your behalf, because if they're going through a placement agent to get the securities to market, then they've already done some sort of underwriting and thorough analysis. That doesn't necessarily fully exist on a private placement type of offering. So then the onus becomes on the investor themselves, right? So I think that's the biggest dichotomy, is that it is more of a self-service type of offering, and you need to either have counsel that can not literally counsel, but someone that you trust that can interpret the offering on your behalf. Whereas in a more traditional offering, that oftentimes has already been conducted.
Here's another.
Yep.
Eitan, how much more difficult is a offering circular for Reg A versus the offering document that you file for Form C? Somebody says that it seems like the content is similar, and there is some overlap there. And then, as a follow-up, why $100,000 cost? And is the cost 90% legal fees, Eitan?
On average, and this is all publicly available, if you look at the SEC's Edgar filings, and you open up some of the 1A offering circulars that are required to be on every single Reg A offering page, right? This isn't, what you'll find is, let's say, average legal costs, let's say $60,000 if there's no issues, right? It's just not too much back and forth. And then there's broker-dealer cost, and then there's, for things like diligence and onboarding, and then there's the cost of accounting, right, for the audited financials. And so on average, we're seeing roughly $90,000 to $100,000 in sunk cost to cover legal, broker-dealer, and accounting. Now, if there's extensive accounting work that needs to be done for an existing company, that number could be an unlimited number. But I'm saying for a new typically for a new issuing entity that's entering and launching a Reg A, expect to spend, let's say, up to $100,000 or so to get you to the point where you're qualified, right? That's not including marketing. It's not including technology. This is more for kind of like the structural components that go into getting qualification. And it's a lot bigger of a job, the Form 1A than the Form C. It's $60,000 bigger of a job, and it's 4 months bigger of a job, and it also requires, you're also going to be, the SEC may come back with questions, right, on structure, and so you have to respond, and you have to make edits to the offering circular frequently. So it's a more extensive process for sure.
It takes some time. So Matt, there are for an accredited investor, you can invest whatever you want, but under Reg A and Reg CF, there is a limit. Do you know those off the top of your head? Because somebody's asking about how much they can invest.
That's the greater of 10% of their net worth or their gross income. And Eitan, correct me if I'm wrong, but I'm not sure if on the Reg A that I don't think it can include primary residence similar.
Right, correct. Right. Yeah. Outside of other than the value of your primary residence. Yeah, correct.
Here's one for you, Eitan. How does your firm help to create buzz and interest for a securities offering that goes through your platform?
We're not so concerned about creating buzz. It's really, we're pretty sobering when it comes to that. We're not saying, hey, sign up with us and you expect 1 million investors. We're really focused on reality, which is this is going to all fall on your shoulders. We're going to do everything we can to be helpful. We're going to point to what's working, what isn't. We think we know most of the marketing and promotional strategies and companies out there because of the scope of clients that we have. But at the end of the day, we believe in being really conservative, setting expectations properly from the beginning, which is if you don't have a community that you're building and you're relying solely on digital marketing, right, to try to get leads in to sell your offering, expect it to be a bumpy road. Expect it to be more expensive than marketing companies might lead you to believe. But if you go into it with the right expectations, or if you figure out how to win before you start, you show up with the community, you have a unique way to generate a community, then it can be really compelling. But oftentimes when you compare that, even if there's a higher cost of capital, right, for marketing and promotion at first, when you compare that to what is available from private equity VC with the covenants or not available, it's the fact that you could take your structure and your valuation and your terms out to the public, take it or leave it, is really compelling. And we're going to see a lot more growth in that space.
Yeah, so to distill that down, so if you start with an established community, people that buy your product or support your product, it's easier. But when you look at Phoenix, you guys created your own community, and now you're going back to them and building off that. So, you can do it both ways. It all takes effort. Let's see. What does it cost to use your services, Eitan? I actually was looking at your site the other day, and I think it's
very rare. We have even more that are going to be. We have a couple more tech tools that we're putting on there, but it's unusual in the industry. But we actually put our pricing on our website, so everyone could go under resources and pricing and see it for themselves. But to answer your question, for a Regulation A offering, we have a $5,000 upfront due diligence fee. We have an additional $20,000 fee that is due when we receive a no objection letter from FINRA, which is needed in addition to SEC qualification by the SEC. And then it's 1% of total funds raised. That's the broker-dealer component. And then we have technology tools that vary depending on what type of experience and tech, or whether they want an app, on top of that.
Yeah, here's one I'm going to answer very quickly. For Reg CF, you either have to use a funding portal, which is kind of like a broker-dealer light, or a broker-dealer. There's about 88 approved funding portals. Only a handful provide services really in any meaningful way. And then there's several broker-dealers that are servicing this industry, and Eitan happens to be one of them, and one of the biggest. See what else we got here. Let's see. How can I effectively diversify my investment portfolio by incorporating debt offerings from the company's leveraging crowdfunding? What strategies can I employ to manage risk and maximize returns? That's kind of a broad strategy thing. And Eitan, I actually think this is an opportunity for you, but what are your thoughts on diversification?
I try to stay away from giving investment advice in that way. Instead, we're focused more on, bringing regulatory compliant investment opportunities to the public for consideration. In general, though, I would say that once you do your diligence and once you feel comfortable making an investment, diversification is good. There's no rush. You could start slow. You could make a minimum investment somewhere on a platform and see how that experience works. See if they pay you next month when they're supposed to. See what the customer service and the overall experience is like before there's no rush, especially in this environment. There's diversification is probably a good place to start.
Yeah, I agree. Because it mitigates risk, and it actually starts in school. They said 30. Investments was the point that you should base it off of, but actually that diversification benefits happens at a far lower number of individual securities. So the last question here, because we're already past time. I have an OTC Pink listed company. Can we raise capital via crowdfunding?
Reg A, yeah, absolutely. You could be a OTC company and utilize the Regulation A exemption. The challenge is, though, you have to have a fixed share price, and so how does that work when you have a fluctuating stock price? So there's multiple ways that you could approach that. One of which is, including a warrant for the Reg A security. But we are seeing more and more OTC companies, utilize Reg A because you're able to produce freely tradable securities and market broadly through social media to anyone over the age of 18. So that's an interesting opportunity and potential to build, to expand your investor community. We're also seeing companies utilize it prior to going public in hopes of increasing their shareholder base and capitalization to meet certain listing requirements. So, definitely a lot of connection there.
Okay, so and thank you for that. That's actually very, very helpful to me. So I'm going to cut it off here. I'm going to ask Matt if you have any parting words you want to share with us.
No, I really feel like this was a nice forum for this. I want to thank both of you for including me. I think that this is really just something that is worthy of exploring, regardless of what brought you here today. Maybe you were on the issuer side, maybe you're just curious, maybe you're an investor. What we're giving you here is options that not everyone knows exist. And that could be from an issuer side, from an investor side, but it doesn't change investing and it doesn't change issuing securities. So it's just a different way that this whole industry has evolved, and one that I've found to be very efficient. Now, our experience is unique. I can't say that everyone's going to go out and raise $500 million next year. But what I can say is that there is a lot of appetite. There are investors today that will look at an alternative investment that would not have 2 or 5 years ago. So I think that this is probably still in the first, second, or third inning as well. And so it is a nice time to explore it. With that said, if I can be of a resource to anyone, I mean, I obviously have my plate full with a full-time job, but I do have no problem imparting or sharing information with folks that would find it helpful, whatever that means. So I appreciate you having me.
Careful, Matt. Careful, Matt. Every issuer of ours is going to call you and take you up on that offer. So before you,
should be a bounty on my life.
Eitan, any final words?
We're just really obsessed with creating tools that providing these tools to issuers so that they could innovate and issue creative securities, private securities to market. We're focusing on tools that assist in community building and technology, that assists with things like abandoned cart and funnel management. Again, this is a very closely tied into e-commerce type of a capital raising proposition, small investment amounts on ACH or even credit cards in some cases. So we're really focused on reducing friction and bringing a well-trodden regulatory and compliant path to issuers, because we're so bullish on the growth of the private capital markets and bringing investors more opportunities that they could otherwise in the past haven't been able to so easily participate in, that now they're able to.
Awesome. Thank you for that, Eitan. Okay, so I'm going to end it here now. I want to thank everybody who has joined us today to learn about crowdfunding and debt securities. I think both of you, Matt and Eitan, really provided a lot of information that's very helpful. I learned quite a bit. And I'd also like to ask everybody to join us next month on December 12th, because we're going to do kind of an end of the year wrap-up webinar where we're going to talk about everything that's happened in the past year, all the good and the bad. And so please join us for that. If anybody has any subjects that they want us to cover, please message me on LinkedIn. I'd love to add your point of view. So with that being said, thank you guys for joining us today, Matt, Eitan, and I look forward to seeing everybody soon. Thank you very much.